Video you'll discover the biggest supply and demand trading mistakes that cost traders money, how to properly use top-down analysis for higher win rates, why waiting for candlestick confirmation is crucial before entering a trade, the right risk-to-reward ratio that keeps you profitable long-term, how to handle psychological traps like stop hunts and liquidity sweeps. If you want to avoid costly mistakes and start trading supply and demand like a pro, make sure to watch until the end. This could change your trading game. And before we dive in, don't forget to like this video and subscribe to the channel for more high-quality trading lessons to take your skills to the next level. Let's get started. What exactly are supply and demand zones, and why do the world's best traders rely on them? Simply put, a supply zone is a price area where selling pressure becomes so intense that it stops prices from climbing higher. A demand zone is exactly the opposite. It's an area on your chart where buyers step in aggressively, stopping prices from dropping further. Usually, demand zones form after a market decline. Institutions see these lower prices as valuable buying opportunities, jumping in with massive orders and driving prices upward again. Now, here's the secret. These supply and demand zones consistently appear in 4 distinct patterns. When you master these 4 patterns, you'll start seeing precisely where the market is likely to reverse or continue its trend, putting you miles ahead of traders who are simply guessing. From my experience, there are 4 critical criteria to identify high-probability supply and demand zones. As you can clearly see, we have a demand zone forming right here. Now, let's carefully break it down step by step to determine if this is a high-quality zone worth trading, or if it's one we should avoid. First, let's examine the candle size leading into this demand zone. Notice these large, bold candles pushing strongly upward, almost no wicks, consistent direction, clear institutional footprints. Big, solid candles like these tell us one thing clearly. This move was driven by serious institutional buying power, exactly the strength we want in a high-probability zone. Next, we check for freshness. Has the market tested this zone before? Take a close look. This demand zone is completely fresh. It's never been touched since it formed, which means when price eventually revisits this area, the reaction is likely to be sharp and powerful. Remember, fresh zones offer the most explosive reactions, giving us the highest probability setups. Third, let's see if there was a clear breakout of market structure. Look closely. This bullish move smashed through previous key resistance levels, creating new market highs. This isn't random, it's smart money deliberately pushing the market higher to trap retail traders, triggering stop losses along the way. A structure breakout like this is a hallmark of institutional involvement and confirms the strength of this demand zone. Finally, and critically important, let's confirm our risk-to-reward ratio. From our potential entry point at this zone, we clearly have at least a 3-to-1 reward-to-risk setup, exactly our minimum standard. Even if not every trade is a winner, consistently taking trades with a strong risk-to-reward ratio ensures long-term profitability. So, based on our 4 powerful criteria, strong candle size, zone freshness, a clear breakout of market structure, and the right risk-to-reward ratio, this zone absolutely qualifies as a high-probability demand zone. Now, let's jump into another real chart, this time focusing on a supply zone. We'll quickly run it through our 4 key criteria to see if it's a high-quality setup worth trading. First, take a close look at the candle size. Notice these large, bold, bearish candles leading directly into the supply zone. These big candles show clear institutional selling pressure, exactly what we want to see for a strong zone. Next, check the freshness. Has this zone been tested before? Clearly not, it's completely fresh. This means that when price eventually comes back to this level, we can expect a powerful reaction, offering us a prime entry opportunity. Third, look carefully at how this move broke below a major support level, a clear breakout of structure. This indicates that smart money was heavily involved, driving prices lower and trapping retail traders along the way. Finally, we have our risk-to-reward ratio. This setup offers at least a solid 3-to-1 reward to risk, giving us confidence that, even with occasional losses, we remain profitable long-term. Based on our 4 criteria, strong candles, freshness of the zone, breakout of structure, and an excellent risk-to-reward ratio, this supply zone clearly checks all the boxes. It's definitely a high-probability setup worth serious consideration. But now, let's look at another chart example, a demand zone that at first glance seems promising. But here's why you should avoid it despite the initial good impression. At first, the candles leading into the demand zone look great. Large, consistent bullish candles signaling strong institutional buying. That's promising, right? The zone is also fresh, completely untouched, another positive sign meaning potential for a strong initial reaction. Additionally, there's a clear breakout of structure as the market pushed decisively above a resistance level, another green flag indicating institutional involvement. However, here's the crucial problem. When we carefully calculate our risk-to-reward ratio, it simply doesn't reach our essential 3-to-1 minimum. Even though it looks good initially, the potential reward doesn't justify the risk. Remember, when trading, if even one of these 4 criteria is missing, the trade immediately becomes too risky. We are laser-focused on only trading high-probability setups that check every single box. This discipline, only trading when every factor aligns perfectly, is exactly how professional traders consistently stay profitable. A major mistake traders make when trading supply and demand is jumping into trades too early without waiting for clear candlestick confirmation. Even the strongest looking zone can fail if you rely solely on limit orders without confirming that price is genuinely reacting at that level. Let's break this down clearly with some practical examples. Imagine you spot a demand zone on the daily chart that meets every criterion perfectly. Candle size, large consistent bullish candles showing clear institutional buying. Freshness, the zone is untouched, ensuring high probability for the first retest. Breakout of structure, price broke strongly above previous resistance, clearly signaling smart money involvement. Risk to reward ratio offers an excellent 5-to-1 potential profit. Because the zone looks perfect, you place a limit buy order right at the zone without waiting for confirmation. But as price returns, it slices straight through your entry, stopping you out immediately. Why did this happen? You skipped one crucial step, waiting for a candlestick confirmation signal. Candlestick signals confirm that institutional buyers or sellers are stepping back into the market precisely at your zone. Without this confirmation, even the strongest looking zone is essentially a guess. Now, let's redo the scenario correctly using clear price action signals. The same demand zone is revisited, but this time you wait patiently. As the price touches the zone, a clear bullish pin bar forms, long wick pushing deeply into your demand zone, quickly rejecting lower prices and closing near the highs. Why is this pin bar important? It proves institutions are actively stepping in at this exact price level. The rejection confirms the zone's validity, acting as a strong confluence factor. You now enter with confidence, significantly increasing your odds of success. This trade quickly moves upward, capturing your 5-to-1 reward to risk profit target. Now, let's break down a powerful supply zone trade on the Canadian Swiss franc daily chart, a textbook example of why waiting for confirmation is crucial. As you can see, price retested our supply zone, and this time something important happened. A doji candle formed right at the zone. This isn't just any doji. This is a gravestone doji, a strong bearish reversal signal. It has a long upper wick, showing that buyers tried to push price higher but got completely rejected. There's little to no lower wick, meaning sellers took control and pushed price back down by the close. It closes near its open price, signaling indecision at first, but strong bearish sentiment overall. When a gravestone doji forms inside a supply zone, it confirms that the zone is valid and that a move downward is highly likely. Look at what happened next. Just as expected, the market dropped aggressively, hitting our target with a solid 3-to-1 reward to risk ratio. This trade worked because we combined a strong supply zone with a powerful candlestick confirmation, stacking multiple confluences for a high probability setup. This is exactly why waiting for price action signals like the gravestone doji at key supply zones can significantly improve your win rate. Now, let's look at another great example of a high probability demand zone trade. As you can see, the market forms a strong demand zone. The move that forms the zone is strong. Price drops aggressively before reversing with large bullish candles, indicating a powerful shift in momentum. The candles are big and decisive, confirming institutional buying activity. The previous level was broken, showing a clear market structure shift. The zone offers a great risk-to-reward ratio, making it an ideal setup. Once price retraced back to the zone, we got a clear inside bar candlestick pattern, a key signal that price action is stalling. Why is this important? The inside bar indicates market indecision. Buyers and sellers are battling it out, but sellers are failing to push price lower. This hesitation at the demand zone suggests that selling pressure is weakening, meaning a reversal is likely. To trade this setup, you place an entry on the breakout of the inside bar, a stop loss below the demand zone for protection, and the target is the next key resistance level. Look at what happened next. As expected, the market respected the demand zone and surged toward our target. Another winning trade, backed by a strong price action confirmation. Aside from inside bars, you can also use other powerful candlestick patterns to confirm your trades, such as engulfing bars, morning stars, evening stars, and tailed bars. Waiting for candlestick confirmation before entering a trade dramatically increases your win rate and helps you avoid false setups. One of the biggest mistakes traders make with supply and demand trading is focusing solely on a strong zone on their entry time frame without considering the bigger picture. Even if a zone checks all the boxes on your checklist, ignoring the higher time frame context can quickly turn a promising trade into a losing one. Let's break down a real example of why failing to analyze the higher time frame can lead to costly mistakes. On this 4-hour chart of the British pound Swiss franc, we've identified what looks like a perfect supply zone. It checks off all 4 critical criteria. Candle size, large, strong bearish candles signaling clear institutional selling pressure. Freshness, the zone is completely untouched, meaning the first retest has a high probability of reacting strongly. Breakout of structure. Price broke below a key support level, trapping retail traders and confirming smart money involvement. Risk to reward ratio. The setup offers a solid 3-to-1 reward to risk ratio, making it appear like an ideal trade. But here's the crucial mistake many traders make. They fail to check the higher time frame. Now let's switch to the weekly chart and see what's really happening behind the scenes. The market has been in a downtrend, forming a trend line that traders have been following. Then we see a break below a key support level, but instead of continuing lower, price closes back above it. This is a clear liquidity sweep. A classic smart money move designed to trigger stop losses before reversing direction. What does this mean? After this liquidity grab, the market is now primed for a strong bullish move. The breakout of the trend line further confirms the shift in momentum. This suggests that, at least for the next few weeks, the market is likely to trend upward. And here's the problem. This contradicts our 4-hour supply zone trade. Now that we understand the bigger picture, let's look at the 4-hour supply zone again. While the supply zone still looks valid, we now realize that it's against the higher time frame trend. Even though the 4-hour setup meets all the technical criteria, it has a much higher chance of failing because it goes against the overall momentum seen on the weekly chart. So, why higher time frame analysis is crucial? Institutional traders, the real drivers of market direction, operate on higher timeframes. Even the strongest looking zones on lower timeframes can fail if they are counter-trend to the higher timeframe momentum. Let me simplify exactly how you should perform top-down analysis based on your trading style so you can significantly boost your results. If you're scalping on the 5-minute or 15-minute charts, your higher timeframe reference is the hourly chart. Day traders focusing on the hourly chart, your best friend is the daily chart. Swing traders using the 4-hour chart, the weekly chart is your higher timeframe compass. Finally, if you prefer trading on the daily chart due to limited time, use the monthly chart as your higher timeframe guide. Mastering top-down analysis like this ensures every trade you take aligns perfectly with the bigger market picture, significantly boosting your consistency and profitability. One of the most critical mistakes traders make when trading supply and demand is taking trades with poor risk-to-reward ratios, often settling for a 1-to-1 ratio or even less. While a 2-to-1 ratio can still keep you profitable, a 3-to-1 reward-to-risk ratio is significantly more powerful and highly recommended. Let's clearly understand why this matters so much by combining it with the essential risk management rule. One key rule of risk management is the 1-to-2% rule, meaning you never risk more than 1-to-2% of your trading capital on a single trade. This ensures your account stays safe. Even if you experience a series of losing trades, your capital won't be severely damaged. Let's break this down with an easy example. Let's say you have a trading account with a balance of $10,000. Following the 2% rule, your maximum risk per trade is limited to $200. If your stop loss is set 50 pips away from your entry, you must calculate your position size so that a loss of 50 pips equals exactly $200. This ensures that no matter what happens, you never risk losing more than 2% of your account on a single trade. Even if you go through a losing streak and lose 5 trades in a row, your total loss would be $1,000. That's 5 losses of $200 each, totaling 10% of your account. While this may seem discouraging, it is far better than losing a significant portion of your capital. This strategy allows you to stay in the game longer, giving you more opportunities to find profitable trades over time. Now, here's why using a 3-to-1 reward-to-risk ratio can be a game changer. With this ratio, for every dollar you risk, you aim to earn $3 in return. This means you can stay profitable even with a lower win rate. Let's break it down with a simple example. Let's say you risk $200 per trade, which is 2% of a $10,000 account. Your profit target for each trade is $600, maintaining a 3-to-1 reward-to-risk ratio. Even with a low win rate, let's say just 30%, meaning you win only 3 out of every 10 trades, you can still come out ahead. Let's look at the numbers. Now, let's say you take a total of 10 trades. Out of those, 3 are winning trades, each bringing in a $600 profit. That's 3 times 600 for a total profit of $1,800. On the other hand, you have 7 losing trades. Each loss cost you $200. That's 7 times 200 for a total loss of $1,400. Now, let's calculate the final result. Your total profit is $1,800. Your total losses amount to $1,400. Subtracting the losses from the profits, you still end up with a net gain of $400. Notice how powerful this is? Even with a win rate of just 30%, you still come out profitable, all because you maintained a strong 3-to-1 reward to risk ratio. Let me share with you a secret, one that explains why your trading strategy might fail even if it has a 99% win rate. Trading isn't just about strategy or analysis. It's a psychological battle, you versus the market. And trust me, the market knows exactly how to push your emotional buttons. Let's dive right into a real chart scenario to clearly illustrate this. Let's say you've spotted a perfect demand zone. It checks all the boxes. Big, bold, bullish candles signaling clear institutional buying. The zone is completely fresh, untouched, and ready for a powerful reaction. A solid breakout of structure confirms institutional involvement. Your risk-to-reward ratio is excellent, at least 3-to-1. Confidently, you enter the trade, placing your buy order with a tight stop loss just beneath your demand zone. Then suddenly, it happens. Price dips sharply below your zone, triggering your stop loss. Frustration hits instantly. You might think, the market is hunting my stops, why me? But here's the crucial insight. This wasn't random. It was a classic liquidity sweep, a strategic move by institutional traders designed precisely to shake out retail traders and gather liquidity. Now comes your critical moment. Will you let frustration and emotion dominate your decision-making, or will you handle this setback like a professional trader? Let's see how a disciplined trader navigates this situation. After triggering your stop loss, the market quickly reverses and closes back above the demand zone. This reversal is your cue. It signals clearly that the initial dip was just a liquidity grab, not a genuine breakdown. Now you face a choice. Option 1. Give in to frustration, walk away, and let a single losing trade control your emotions. Or Option 2. Stay calm, reassess the situation objectively, and re-enter the trade with a strategic mindset. Here's exactly what a disciplined professional trader does. You recognize the liquidity sweep, calmly wait for price confirmation, and then re-enter the trade. This time, you place your stop loss just below the new low formed during the liquidity sweep, clearly defining your risk. And guess what happens next? The market moves sharply higher, easily hitting your profit target. This trade isn't just a win because it earned profits. It's a bigger win because you overcame the market's psychological trap. You stayed calm, made a strategic decision, and turned what could have been frustration into a clear victory. This scenario isn't isolated. You'll face situations like this often, regardless of your trading method. Whether it's supply and demand, Fibonacci retracements, or any other strategy, the market will always test your emotional strength. Now you have the knowledge to avoid costly trading mistakes and master supply and demand like a pro. But remember, success in trading isn't just about strategy, it's about discipline, patience, and consistency. If you found this video valuable, make sure to hit the like button and subscribe for more in-depth trading insights. And don't forget to turn on notifications so you never miss a new upload. Thanks for watching, and I'll see you in the next one.